points here, real quickly. So David Rosenberg Research this morning, he had a note out saying 90% of the time during rate hiking cycles that the stock market rallies into it. It's not until after they're done that it starts to sell off, which I think is really interesting. And Dave,
into the cycle or through the cycle?
Through the cycle. Through the cycle, and it starts selling off afterwards. And what Steve just said, that quick math, I can do some quick math too. The Fed funds rate back in 2018, remember the last time Powell was raising, got to about 2.5%, okay? And we knew that inflation was 2%. So what was the real rate, Tim? Real quickly, 1.5%.
Okay? No, 50 basis points.
No,
2.5.
Well, it got to 2.5.
You could do math.
Oh, well, sorry. So it was. So the point was, it was. All right, sorry. It was very. No, you know what I was thinking of? You know where the 10-year got to 3.25%. Okay. So it was very accommodative still. Now, but the stock market dropped 20%, right? As soon as we had a little bit of a growth scare, and I think that's really important to think about because we're talking about a 3-day sell-off about 1.5%, and this is like the longest sell-off that we've had in a month and a half. The last thing I'll say about the banks that you just mentioned before, did you guys see all the regional banks? They all guided down for the quarter here. So like if you talk about, and you could say that's very specific to them, but I keep hearing stories, and I think we're going to hear more and more where these REITs are going to be turning the keys in to the banks, okay? And who owns all that paper? It's the regional banks. So I just feel like the back half of this year is not going to be nearly as rosy or just going to pay attention to things that the stock market doesn't seem to care about right now.
In the meantime, though, I mean, even though it's been 3 straight days of losses for the markets, we're still up at.
Well, Apple's at all-time highs.
Exactly.
But I don't think anybody's questioning. Maybe I'm wrong, but most people assume we're having a recession. The question is how shallow. Savina said they think 0.8%.
Like tiny dip.
But to assume that the Fed can tighten sufficiently to get down to 2%. First of all, when core inflation's been stuck at 5.3 for 9 months now, and not take the economy deep into recession is naive. It's just there's no way we can do it. Meanwhile, if you think about the recession we should have had during COVID, which we didn't have because we threw so much M2 at the problem, and you're now trying to it just the question really is how much should stocks begin to price in recession? And they haven't priced in much here.
Yep. For more on all of this, let's bring in Joe Livornia of SMBC Nikko Securities America. He was formerly the chief economist for the National Economic Council. Joe, always great to see you.
Thank you.
If the Fed's inflation target really is 2% and remains 2%, does that mean that we have to have a recession?
No, I mean, listening to when Karen asked Steve about, would they cut with inflation still above 2? My answer is yes. It depends really on the unemployment rate. And in the Fed's forecast, which showed 2% core inflation in 25, they've got their unemployment rate well above 4%. They lowered it from where it had been, but it's still well above 4. I think it peaks at like 4.3 or 4.5, somewhere around there. That would be consistent with recession. So I would argue if the labor market weakens in the next few months and we see that rate move up above 4, we'll have a recession because we know historically, going back to data to Second World War, when the unemployment rate rises 50 basis points from its low, we've always had a downturn. And my guess is when that happens, when the Fed actually sees it, they will pivot, meaning they will focus on the unemployment rate, which is a leading indicator of inflation, and they won't worry about where the inflation rate is at that point in time.
So it sounds like you think there will be a recession, but then in response to a recession, the Fed will quickly pivot. So that brings into the picture a rate cut, if pivot means cut, this year.
Yes. I mean, I remember in 2007, we at the time thought the economy was very weak. There was excess housing leverage, excess allocation of capital to housing. And the Fed wound up pivoting very quickly, basically within 3 days in August of 2007. They wound up cutting 100 basis points for the year. So again, this is the if the labor market breaks, and we'll get some data tomorrow, Melissa, that cover claims for the survey week, and they've been edging up, very gradual, but edging up. If we get some weak employment data in the next few months, and we're due for it, we've had, I think, 14 consecutive months where the street has underestimated payrolls. It's a record long in terms of length. Then I think things can happen very quickly, and you actually could see the Fed cut this year. So I would not rule that rate cut out. Absolutely not.
Joe, it's Karen. Let me ask something. You talked about a 50 basis point increase in the unemployment rate triggering a recession, but has it ever been a 50 basis point increase with a with a unemployment rate as low as it is now?
Yes, we've had the unemployment rate actually a couple of times below where it is now. We've had it one time around 2.5% in the 50s and one up well over 6. So yes, it doesn't really matter where it's starting. Where it goes, where it rises, is going to be partly a function, Karen, of how deep the recession is. And the reality is, whenever the next recession happens, we really have no idea if it's going to be deep or shallow. This notion it's going to be shallow, I'm not sure what it's predicated on. We thought when the economy, I say we collectively, when the recession hit in '08, it was going to be shallow. In fact, the economy even grew almost 2.5% in the second quarter of '08. Whether it's shallow or not will depend in part on what the Fed reaction function is to the economy at that time. And my guess is with the election next year and fiscal policy as messy as it is right now, you're going to get no fiscal relief. So when it comes, it could be a deep recession.
Joe, you're unlike many economists, and meaning you're cool because you like Van Halen. But most economists aren't able to predict or even get out there and predict where the economy's going. Why I connected these two, I just wanted to point out that I met you at a Van Halen concert once, serendipitously.
I do love Van Halen. I would say I wouldn't like. I'd say I love.
You love Van Halen. I don't love that economists never seem to be willing to get out there and anticipate where the economy is going. And I don't mean you, and maybe I'm really talking about the Fed. If we all know that labor is going to slow, we all know the economy is slowing, why can't the Fed say, I think the economy is going to be here in 6 months, so I'll take policy there right now? Why are we so data dependent? Why are we waiting on a lag we all know is there?
The answer is, Tim, it's political, I think. And I think one of the reasons that Chair Powell, I think he made a commitment to the president to get inflation down. And again, it's a forecast that the rate now, it's up 3.4 to 3.7. History would say if it goes to 4.0, you're going to have a recession. You'd be in recession. So I think it's that commitment to get inflation down and the uncertainty that it's a forecast. It doesn't, it's a forecast. It means it may not happen. And to me, that's why Jay Powell has done what he's done. And they really want to see more evidence that they need to be where they want to be. But Tim, this is also the litany or the history of the Fed. The Fed always overdoes it. And this would be yet another example of the Fed overdoing it, because when it happens in real time, for whatever reason, they forget about the lags, and the politics may be such they have to keep pushing. And it's a mistake.
Joe, thanks. Always good to see you. Joe Livornia.
Thanks, everybody.
So Joe's basically saying, let's not believe the Fed here. He doesn't believe the Fed here. Steve was just saying Fed funds futures. They don't believe the Fed here. They don't believe what Jerome Powell said today on the Hill. Guy, I know what you're going to say. I don't know why I go to you. You don't believe the Fed at all.
Well, I mean, to stay with the theme, Jamie's been crying about higher rates for quite some time. Of course, that Jamie being Jamie Dimon. So I would listen to him. And I understand what Joe is saying, but you have to ask yourself this. How bad will things be? And again, with the rhetoric that we heard, for the Fed to be cutting rates at the back half of this year, it does not suggest that stocks will be continue on their merry way. So he may be right, but if he's right, I actually fear for what the outcome is going to be in terms of the stock market.
Coming up, an earnings alert on KB Home. Shares on the move after reporting results. Details on that quarter and the home building space next. Plus, chips taking a big breather after a huge run this year. Why these semi stocks are pulling back and how you should play this space. Don't go anywhere. Fast Money's back in 2.
guaranteed.
Welcome back to Fast Money. Earnings alert on KB Home. Shares of the home builder volatile after posting both revenue and earnings beats in its latest quarter. The stock is up 65 this year, trading at its highest level since 2007. Diana Olick has got more on the company's report. Diana.
Yeah, Melissa, the mantra for the builders appears to be demand. The analyst call is still going on right now, but at the top, CEO Jeff Metzger said buyers are demonstrating a higher sense of urgency than we saw earlier this year. So no surprise, KB beat nicely on the top and bottom lines. Metzger said in the release, the improvement in demand we started to see in February was sustained throughout our second quarter as we achieved monthly sequential increases in our net orders. He said they've lowered both build times and direct construction costs, but KB's gross profit margin dropped to 21% from 25%. They said mainly due to price decreases and other home buyer concessions, together with higher construction costs and a shift in the mix of homes delivered. Now, the average sale price dropped 3% year over year, but the cancellation rate of 22%, it was up from 17% a year ago, but down quarter to quarter from 36%. So there, Melissa, is your urgency right in the number.
Why are construction costs higher, Diana? I would have thought that they would be lower given the decline in commodities. Was it all wage inflation?
There's wage inflation, of course, that has to do with labor, but it's actually the cost of lumber came down, but the cost of other things that go into the home are still much higher. So, I mean, with the headlines tend to be low, lumber's down, but when you look at some strange things that you wouldn't think go into the home that have to do with like HVAC systems and other things are actually a lot higher.
All right, Diana, thank you. Diana Olick on KB Home. Karen, you were looking at this quarter. Looked pretty good.
Yeah, it actually looked pretty good. I mean, the gross margin being narrow with that would explain some of the, and the guide, relative to the size of the beat on a revenue, which was really big, the guide sort of made it seem sort of muted for the rest of the year, although the commentary sounds pretty upbeat, actually. So there is a giant disconnect there in the whole, I don't know, not just home building, but in the whole housing market, in that you have demand there, but you have this giant, wrench in the system of rates being where they are. Yet houses are forming. Millennials do want to buy homes. I guess you just need some time to get used to these rates.
The average contract rate
was
of a 30-year fixed mortgage, 6.73%. So it didn't come down a lot at all during this quarter. I mean, that really worked against them if there was, a headwind there.
But 90% of the mortgages outstanding are probably all below 4% at this point. So no one's going anywhere. But yet, if you look at the recovery in the NAHB index, it's had the fiercest recovery over the last 6 months of any period other than coming out of COVID. So we've talked about the home builders. Guys done a great job of flagging this a long time ago. You have a case where, first of all, the charts on these companies are extraordinary. You look at KBH, somewhere around $52, $53. You have that May 21 resistance. A couple of the others have gone straight through. But the bigger home builders have a place to actually outperform a lot of the smaller guys because of their scale at this point. And I think the multiples are not terribly demanding.
Guy?
KBH has actually underperformed the rest of the group. You made the point, the highest we've seen since 07. You got to go back to March 06, I think, when this was a $65 stock. That was the all-time high. To Tim's point, you look at Toll Brothers, Pulte Homes, both of those stocks are significantly through their prior all-time high. They're off to the races. But I look at the numbers. Diana mentioned gross margins. She was right to mention that was sequentially lower at 21.4%, but it was better than the street was expecting. So the street had priced in sub 21. And then quickly, Mel, you look at deliveries. I mean, 3,665 deliveries versus expected of 2,965. That's significant because the price is held in. So it's a really good quarter. It shouldn't be all that surprising, again, given the supply-demand fundamentals, which are still in place for the space.
There's still a lot more Fast Money to come. Here's what's coming up next.
A chip check on deck. Semi stocks in the red today. But is this just a tech timeout before another big bump? The traders debate next. Plus, Biden's faux pas. The president's choice words for China's leader at a crucial time for the two countries. Was it just bluster or a real blunder? You're watching Fast Money, live from the NASDAQ market site in Times Square. We're back right after this. BC.
Yeah.
Welcome back to Fast Money. Buzzkill on semis. The SMH semiconductor ETF dropping more than 2% for a fourth straight day of losses, also seeing its worst day in 3 weeks. Take a look at some of the individual names seeing big losses today. Intel dropping 6% after hosting an event with updates to its internal foundry model. That stock was the biggest laggard in the S&P 500 today. AMD dropping nearly 6%, while Qualcomm and Marvell each fell more than 3%. Dan, is this the beginning of the decline, the demise of this trade?
I don't know. I mean, listen, like look at Nvidia. You just said the SMH closed down 2.25%. Nvidia, which is a trillion-dollar market cap company, and it's literally encapsulated so much of the enthusiasm of this recent run, closed down 1.75%. You know what I mean? So you have AMD and you have Intel, down 6%. I think that those sorts of moves, we have not seen those in large cap tech stocks in a very long time. You would not like to see that kind of spread out a little bit to some of these other names, because they will eventually get to a name like NVIDIA. And if you look at AMD, it filled in that gap from when NVIDIA gapped, okay? And so that gap in NVIDIA is massive. It's hundreds of billions of dollars in market cap. At some point, it will be filled. And I just don't, obviously I don't know when, and it's been a hard trade trying to short it.
Are you still in it?
Yeah. But it's been hard, and I keep defining my risk. Yeah, sooner or later I'm going to have to give up. No? I'm just saying.
No, because it's interesting, because the way you interpreted NVIDIA's move today was that it should have fallen and it will fall.
Yeah.
Or you could say, on the flip side, it outperformed and held up well, and so therefore had good price action in the face of.
Yeah, so did Apple today. It was down 50 basis points.
That attests to NVIDIA's strength here.
Well, at some point with NVIDIA, I think you are running with the devil. And I think you've got a case where there's been a lot priced into this. But I continue to think that the market has an enormous amount of positioning and momentum. And I think there's a lot of passive money that seems to be chasing here. So, again, a lot of the reasons I hear bears not capitulating, and I'm not talking about down, I'm talking about strategists that are out there with views on the street that have been quite negative. They're saying this can run longer, and it can run longer because Karen mentioned that the Fed is in a position to play the ice cream man and actually be around a little bit, not until the end of July. You have seasonal factors where the NASDAQ has its best month in July if you look over history. I mean, there's reasons why you can melt higher here. It doesn't mean it ascribes to fundamentals that I can believe in here, but I believe the market could go higher.
Is running with the debt, is that some sort of reference?
Yes, I think I just got 3 Halen songs right there, and I know the folks at home are playing along. So,
Guy, quickly, your take on NVIDIA's price action.
It was not nearly as bad as I thought it would be, but quickly, we talked about this last week in AMD. They reported May 4th. Stock was down 10% on earnings. I mean, margins were not good. And then you had this, wait for it, Mel, eruption to the upside the next day when they announced seemingly this relationship with Microsoft where they're going to compete with NVIDIA. That stock proceeded to go up 55% over the next month and a half. Nothing changed other than the price. So, I mean, AMD's a great company. That last quarter was not particularly good. Price action was great. So, NVIDIA surprises me. I think they have, I want to say they have an analyst. They have something coming up which may be a catalyst. We'll see. But, man, you're in the deep end of the pool in valuation with that one for sure, Melms.
By the way, Mel, you could have just said.
Deep end of the pool, is that some sort of reference?
No, but you could have just said to Guy, you know what, Guy, you really got me.
And that is one.
That is one.
Okay. Thanks for the clarification.
You might as well jump to a commercial.
Biden's trying to slip up. The faux pas the president made within basically a day of Secretary Blinken's visit that was considered successful, in the country's corporate spy war unfolding beneath the surface. We got more on that next. Plus, a big day for Bitcoin, the crypto breaking above a key level for the first time in over a month. White is getting investors in one name particularly excited. Fast Money's back right after this. Day of losses after Fed Chair Jerome Powell indicated more rate hikes are likely this year. The Dow dropping more than 100 points, the S&P falling 0.5%, and the Nasdaq leading the losses down more than 1%. A few names bucking the trend, though, and trading near all-time highs. Home builders, just talked about them. D.R. Horton and Pulte Group specifically, plus McKesson, Owens Corning, and Cardinal Health all hovering near those levels. Insurance stocks also seeing a bounce after last week's weakness. United Health, Elevance, and Humana all higher. Meantime, President Biden making a potentially big blunder at a campaign fundraiser in California. Biden referring to China's Xi Jinping as a dictator. The remarks coming just over a day after Secretary of State Antony Blinken wrapped up his first official visit to Beijing, saying the two countries had made progress on their strained relationship. The reaction from China, Tim, was maybe not surprisingly indignant, to say the least.
No, and I tell you, I think this is a surprise. This was a bit unchained, I would say, by the president, because, I mean, this is not what you do in diplomatic circles. Other presidents have had much, I think, more clear examples of the D word, dictatorship, that is, and that they haven't used. And I guess I'm just really surprised, considering the timing of what we had just done. We had just sent our Secretary of State. There's an attempt to thaw. And if you think about the Biden administration, there's been 3 or 4 times where I think they've gone into kind of, crossed red lines, especially as it relates to the Taiwan relationship and things that I think, leaving aside China doing something in Taiwan, but until then, and I'm not saying we need to be sitting here thinking that there couldn't be some elements of the China-Taiwan relationship that could get very thorny and very bad for the world. But it's been surprising the way we've handled this to me, especially when I do think that we've done a lot to protect strategic interests in the tech sector, and we will continue to do so. And I think there's a lot of rancor to be worked through.
Yeah, I mean, the Chinese foreign minister said this was a public political provocation. I'm sure he picked those words very carefully. Sticking with China here, we do have a new documentary premiering tonight. It's called China's Corporate Spy War. CNBC's Eamon Javers details a sting operation that took down a Chinese government spy who tried to steal jet engine technology from GE. He interviews the U.S. attorneys who investigated the case. Here's a first look.
It's late winter, and in China, festivities to celebrate the Lunar New Year are rapidly approaching. The Ministry of State Security spy Xu Yanjun is receiving messages from the GE engineer, who he doesn't know is now a double agent for the FBI. Their chats are friendly, encouraging even. Then Xu makes a bold request. He asks for the engineer's laptop directory.
He attaches instructions on exactly how
here's
he wants
how you
him
do
to
it.
Yes.
Step 1, create a notepad document. Step 2, open it and entering the following content. So he's giving him literally step-by-step instructions on how to send him GE information.
Yeah, and this is the type of document that should make U.S. companies nervous. This is exactly the steps that you go through if you want to copy your company computer and give it to China.
Eamon Javers joins us now. Eamon, what a fascinating documentary. I've read through some of the other clips out there that have circulated today. I'm wondering, in terms of the effort against the United States to, steal IP or steal whatever information, does it go in waves? Does it increase when there are higher tensions between the two countries, such as now?
It doesn't seem to go that way, Melissa, and I think largely because these operations take a long time to put together, right? So you don't have the sort of spikes moment to moment when the tensions increase. They say, okay, dial up a number of spy operations, because these things take months, if not years. But what you do see is it's very coordinated with the Chinese companies on the back end. The companies are in communication, according to people I've talked to, with the Chinese government and the Chinese spy agencies, and they literally give them a list of technology that they would like to get. The Chinese spy agencies then task their agents to go out into the world and find that. And that's what happened in this case that we detail in the documentary tonight involving GE Aviation. The Chinese Ministry of State Security officer found the GE engineer who had the specific knowledge that he wanted, and then started working on that guy to try to get that guy to leak him that laptop directory with all the secret information on it.
Should there be extra concern for companies that have partnerships with, because that was the way you got into China in the first place for many U.S. companies. You have partnerships with Chinese companies, that those companies are at particular risk?
Yeah, absolutely. When you do the joint venture in China, that gives the Chinese government a lot more leverage over you. There are some companies that don't have a joint venture agreement. I believe Apple is sort of a keynote example of that. Other companies do have that. So that puts you in a different basket. But I talked to Senator Marco Rubio for this documentary, and he's the ranking member on the Senate Intelligence Committee. He said, in his view, American companies are committing long-term suicide in their approach to China, and that they're simply exposing too much of their intellectual property by doing these joint ventures and doing these deals in China that are risking their long-term survival as companies in exchange for short-term gain. And he said that the CEOs, in many cases, understand this, but they're doing this anyway because they have a quarterly number that they've got to hit. And they're not worried about what's going to happen in 5 to 10 years because they probably won't be the CEO of the company by then.
Eamon, thank you. It's a fascinating look. We hope everybody will tune in. The CNBC documentary, China's Corporate Spy War, premieres tonight, 10 p.m. Eastern Time. It's chilling, absolutely chilling, some of the examples that Eamon has in this. Coming up, a June boom for Bitcoin. Why the rally in crypto? Well, we'll bring you the details in the trade next. And throughout June, CNBC is celebrating Pride Month. Here's the president and CEO of GLAD.
Coming out for me at work helped surge my career. I wasn't hiding who I was. That takes an extraordinary amount of energy and time and resource that you could be putting against your career, your job, your clients, your employees. And so for me, when I was in the magazine business and I finally came out, I saw my career take off. So be who you are. Bring your full self to work. It will only make your career even better.
Welcome back to Fast Money. Bitcoin cracking the $30,000 mark for the first time since mid-April today as traders gear up for major players like BlackRock to jump into the space. Earlier this week, the institutional giant submitted an application for a spot Bitcoin ETF. Investors betting that gives hope to Grayscale's planned conversion to an ETF. The Bitcoin Trust is trading at the smallest discount to net asset value since last September, Karen.
Yes. However, it's still not the smallest discount that it's ever traded at. And in fact, it used to trade at a significant premium because there was no other way to get into Bitcoin for most retail investors. So fast forward to here, we're down, I don't know, now we're at a discount of 30%. The average for the last year has been down 38%. So it's not that much of a close. Makes me think there's room to go. And if you combine that with the underlying also moving up, that's a nice thing. I think it could go. The GBTC part, I think, could go higher. Also, we saw Wisdom Tree. Did they file a ETF as well?
BlackRock
About 5 people
first,
have.
And then, and
There's a
so
flood.
People, and it makes you think.
So what do they
Does
know?
BlackRock know something?
Yes.
If everybody else is following, this is an interesting take that Cameron Winklevoss tweeted earlier today. Anyone watching the flurry of ETF filings understands the window to purchase pre-IPO Bitcoin before ETFs go live and open the floodgates is closing fast. So I thought that was a, sort of an interesting spin on it.
Yeah, especially as there's been so much volatility in and around the exchanges, regulatory as it relates to them. Listen, Coinbase, Crypto.com, these are exchanges a lot of pros use. There's a lot of like the sorts of, they've been building the infrastructure where, you know, semi-pros and pros can trade on them. And it's been an easy, accessible thing also for retail. These ETFs change the game, I think, as from a whole host of reasons.
Yeah.
So I think the thing people are targeting around the BlackRock filing that's a little bit different is it allows surveillance of the underlying trust by NASDAQ, for example. And that's the kind of, at least, you know, it begins to give both more, it's not regulatory oversight, although it does begin to put more accountability. And it's just, all of this is fascinating because, you know, where were we 3 weeks ago with the attack on Coinbase? And the SEC seemingly has been gnashing its teeth and saying, first of all, let's determine what are truly registered as securities and what are not. And if they're securities, you're going to be under our watch. But that's the whole point. This is why the ETFs should be successful, and there should be some meeting of the minds, because this is a bunch of well-known established players saying, look, we want to be in the space. We want to run this. And in many cases, if you're talking about an ETF, you're talking about an SEC-governed 40 Act fund, which has a whole slew of rules that I think is very good.
Speaking of Coinbase, option traders are betting today's Bitcoin bounce is good news for the stock. Brian Sutton joins us with the action. Brian.
Yeah, traders were gobbling up calls. Basically, we saw a complete flip of puts to call ratio with heavy call buying. This has occurred over the last 5 days where you're seeing more calls to puts trade. What really was interesting was the 19,000 or so call options that traded that are expiring this Friday. These were the June 60 calls, buyers mostly at 90 cents, meaning break even about $60.90 above there. That's unlimited profit potential, only risking 90 cents. Now, obviously, these options expire by Friday, so it's a little risky in that sense. But if Coinbase sort of goes in the money on these call options, trades above this $60 level, you could be looking at a very well-defined head and shoulders bottom situation here. Coinbase has really tracked Bitcoin very well, meaning if Bitcoin is down, Coinbase is usually down. And the two move lockstep. They've kind of separated over the last couple of months here. I think that's maybe because of all the regulation coming down the pipeline that Tim talked about. But we see a pop above 60. Maybe Coinbase moves higher and moves with Bitcoin after that.
All right, Brian, thanks. Brian Stutland. For more options action, tune into the full show Friday, 5:30 p.m. Eastern Time. Coming up, Modi on the move. India's prime minister making a landmark visit to the United States, meeting with top leaders and CEOs, where he is off to next and what it means for investing in India. The details ahead on Fast.
knows healthy life.
Welcome back to Fast Money. India's Prime Minister Narendra Modi in the U.S. for his first state visit, and he's already been very busy. Here's a video of his arrival in New York City yesterday, where he met with Tesla's Elon Musk. Modi will attend a state dinner at the White House tomorrow, and he's also expected to meet a slew of U.S. CEOs, including the heads of Apple, Alphabet, and Microsoft. Tim, how do you feel about India? There's been a lot of foreign inflows into Indian stocks.
And if you look at the INDA, it's a $5 billion, iShares India ETF that's really been on a rocket and has actually broken through some significant upside. I think around 44, 45, you have some resistance, but big names in there: Reliance Industries, ICICI Bank, which is essentially their JP Morgan. India, relative to China, is really a pairs trade that favors India in so many ways right now in terms of both the growth, a deflationary environment, which that's a big debate, but clearly India has always had issues with inflation. A lot of it has been energy inflation. So as oil prices have stabilized and come down, it's very good for India. I think it's a fascinating time to be investing in that part of the world. And you're not buying it at the bottom, but you're certainly, for the asset class, this is the part of the Asian exposure I think you really want.
Your flambe, Karen, has Mexico.
Yes.
Would you look at India?
I would. A lot of the same reasons, right. I mean, the nearshoring, there's the geography of it makes Mexico unique. But we've seen a lot of companies, like Tim was saying, already start to diversify, and they need supply chains in India. Yes, I would.
Guy, what if China becomes, what if they have a lot of stimulus? Do you think that money then gets redirected to there?
Back to China, perhaps. They have their own issues. But I think Tim is right to point out the levels of resistance in INDA, which I think is 30% or so financials. 44 was a high a couple times, last one in December. But this should get up to that 50 level, which we last saw, I think, in November of 2021. So I would take a look at that. At some point, Mel, everybody's going to want some.
Oh,
just really
what happened?
I'm going to dive down into this one here. Really quickly, Biden's comment about Xi, like Modi, one of the biggest criticisms is his assault on democracy in this country. You know what I mean? And it's kind of interesting. This is a very common sort of criticism, especially since he won re-election in 2019. There's been oversight thrown out about election supervision. A lot of stuff going on there, too. So it's funny that he cozies up to Modi here.
Up next, final trades. trade time. Di Dami.
Cradle's going to rock with that EJ doc tonight. Robin Hood, Melms.
Tim.
Yeah, when it's love, it's Walmart. I mean, I think the margin accretion there, they've made major investments in technology and their people, and I think Walmart's going to go.
Chairwoman.
Yes, we are seeing a rotation. Names like Elevance, which was up today, will have room to go higher. Elevance.
Dan.
Yeah, I'm bearishly positioned in the XLF. That would be banks, but I think you can also be that way in the KRE. That's the regional banks.
And stocks in general.
Yeah.
Thanks for watching.
Not Van Halen.
Mad Money with Jim Cramer starts right now.
My mission is simple, to make you money. I'm here to let...
And raising bets for further hikes by the Bank of England, the BOE, which starts meeting today. And U.S. President Joe Biden and Indian Prime Minister Narendra Modi meeting in Washington today as both leaders aim to deepen ties on defense, technology, as well as the economy.
Good morning, everyone. We begin with a recap of the action on Wall Street overnight. The major averages closing in the red for the third session in a row, extending losses as investors digest Fed Chair Jay Powell's latest comments, where he reiterated more rate hikes ahead. More on that in just a bit. Chip stocks pulling back sharply after their recent rally. The Philadelphia Semiconductor Index down 2.7%, its biggest daily decline this month. Let's bring in Steve Kovac. For more on the market moves, Steve, take it away. Good morning.
Hey there, good morning. Yeah, Intel shares fell 6% today after the company updated investors on CEO Pat Gelsinger's turnaround plan. Now, Gelsinger's plan is to make Intel into a chip manufacturer for other companies, putting it in direct competition with leader TSMC. Intel CFO told investors the company will change its financial reporting structure to reflect the new foundry business's profit and loss. Lots of concern from investors there over the margins. Intel hopes to catch up to TSMC by 2026. Meantime, top AI beneficiaries this year having a rough day. That includes names like NVIDIA, which was down nearly 2%, AMD down more than 5%, and Palantir down more than 7%. And shares dipped slightly at Amazon after the FTC sued the company over what it calls deceptive practices getting customers to sign up for Prime subscriptions. FTC saying Amazon tricked millions of shoppers into signing up for Prime membership and sabotaged their attempts to cancel subscriptions. The agency also claims Amazon used so-called dark patterns to steer users to enroll in Prime without their consent. Amazon, in a statement, denied the allegations and said it would prove its case in court. Martin, I'll send things back over to you.
Steve Kovacs, excellent as always. Thank you very much. All right, so we know that Wall Street pulled back. What did fixed income bonds do? Take a look. Here's a look at how yields are shaping up Thursday out here in Asia. The 10, the benchmark at 372.66. The two most sensitive to what the Fed does or does not do. We are now up at 471.95. Call it 472 for practical purposes. Fed Chair Jay Powell reaffirming overnight the central bank's intention to continue hiking rates, saying the FOMC is not done with its battle to try and tame inflation. Here's what he had to say at his semi-annual testimony before the House lawmakers overnight.
We did decide to maintain the federal funds rate at its current rate at this meeting. At the same time, participants submitted personal forecasts suggesting that almost all of them thought there would be additional hikes. And I just want to say those two things are entirely consistent. The point being that the level to which we raise rates is actually a separate question of the speed with which we move. Earlier in the process, speed was very important. It's not very important now. The sense of the summary of economic projections and the decision really is just that, given how far we've come, it may make sense to move rates higher, but to do so at a more moderate pace.
Let's keep talking about this and bring in our first guest this hour. Michael Lighthead is with us, Global Head Fixed Income at New Capital. He joins us live. Michael, good to see you. Hope you've been keeping safe. What did you take away from Chair Powell's, the first of what used to be known of Humphrey Hawkins' testimony up on the Hill? The thing that caught a lot of people's attention is, look, in terms of 2 more rate hikes to come before the end of the year is out. That is in the new summary of economic projections, the new dot plots. Said, look, that's a pretty good guess.
Good morning. Yes, thanks for having me. I guess we're kind of unsurprised by the narrative that's coming out of the Fed and continues to come out of the Fed. I think central banks really have to maintain that hawkish message. I think what's high priority is clearly getting a handle on inflation. And I think it's about credibility, keeping that credibility in the long run. So I expect to see continued hawkish messages until there's really a decisive move on the downside in terms of either economic data or indeed the inflation data. So I would continue to think the Fed and other central banks indeed will continue to sort of peddle this message of the need to be cautious on the on policy rates and keep a very fairly hawkish tone to the narrative.
Yeah, Michael, you know, when the new dot plots came out, it seemed as though the equity market, Wall Street, didn't buy it. You know, the way it reacted, which was positive, it was as if it was saying, look, you say there are 2 more dot plots, I don't think that's going to happen. This time around, we had Wall Street pulling back overnight. So interesting, they seem to be buying it now or believing him. What about the bond market, your space?
I think what we're continuing to see is whenever we have these upside surprises or more hawkish sort of narratives is yield curves become more inverted. I think what the bond market's essentially telling you is today rates need to move a bit higher. Central banks will continue to tinker with the front end of policy rates. But in the long run, you look at things like US 10-year inflation break-evens, and they're still very, very stable around sort of 2 and 2.2%. So I think that's really telling you that near-term rates, due to economic growth and resilient labour markets, may need to be a bit higher. But ultimately, what we're going to see at some point in time is a meaningful slowdown, at least enough to allow central banks to come back to a more normal level of interest rates. I think the big question is whether this causes a more significant economic accident or whether we just see anemic growth for a period of time.
Michael, hi, this is Christine.
So I think from the bond market perspective...
Yeah. Go ahead.
Hi, Christine. No, I think from the bond market perspective, I continue to think that, maybe where we may see policy rates move a little bit higher, bond yields actually maybe continue to be capped. I mean, we're seeing US 10-year treasuries sort of, struggling to make it through 4% at the 5-year part of the curve, and then obviously they've been more subdued sort of further out the maturity spectrum.
Okay, so more yield inversion. Michael, when you say rates will have to go higher, how much higher before rates start to normalize?
I think in terms of Fed fund rates, I think it looks like the US is probably nearer the end of its path than maybe its counterparts in Europe. So I think, if we continue to see economic data come in and maybe surprise to the upside, then I think the Fed's projections are fairly credible. I think if we start to see a softening in the labour market, maybe a continued decline in the sort of earnings, then that might prompt a bit more of an elongated pause. So our kind of view is maybe we've got 1 more hike to go, and then we'll see a pause from there.
Okay, so that's interesting because that's pretty much in line with consensus. We're pricing for about a 2 and 3 chance, make that 3 and 4 chance, 75% chance of a next hike coming in the July meeting. What happens after that, though, Michael?
Historically, if you've looked at the 12 months after central banks the Fed have taken a pause, what you've seen is actually the next move is down. So I think in terms of the way the yield curve's pricing, I think it's fairly consistent with what we see. What it's not consistent with right now is a recessionary environment. And if you look back over the last 50 years, whether you're talking about the more volatile period of the 1970s and 80s, or you're talking about more stable periods in, say, the 90s and the 2000s, what you've seen in a recessionary environment is much more significant rate cuts. And in that environment, I think, you could see US rates come down 400 to 500 basis points. It wouldn't be unrealistic if we had a more heavy recession to see that, even if structurally inflation is maybe a little bit higher on a more strategic basis.
All right, that would be basically a removal of all the tightening that's come from the Fed already.
We'll continue to talk with you, Michael. Stay with us. Michael Lighthead is staying with us, of course. We'll continue our chat with him in just a little bit. And checking in on the crypto space, let's take a look at Bitcoin, breaking the 30,000 level earlier right now, pulling back just a little bit at 29,879. The rally helping to pump up cryptocurrency companies with MicroStrategy, Coinbase, and Riot platforms all up sharply as a result. Taking a look at the board there, as you can see, up the most, MicroStrategy up more than 5%. Squawk Box will be back in 2.
Loaded today.
Good morning, Asia, Australia, New Zealand. Well, it wasn't a day for economic releases, but it was a big day in the markets nonetheless. We had Chairman Powell answering questions, Q&A, in front of the House Financial Services Committee. And even though his words did not have a huge effect in treasuries, they did have a very quick effect on the dollar. And his comments were actually, in my opinion, a bit more hawkish than I would have expected. He certainly talked like a man who was a little bit disappointed, maybe, is that the right word, that they didn't raise rates a quarter of a point, although he seemed happy with his decision. Ultimately, the dollar index responded as though he was uber dovish because interest rates moved down rather dramatically. And after talking to several traders, what they all seemed to have agreed on was that he was not super hawkish, and that in and of itself was enough to propel the dollar index lower, not to mention that it's already been having a bit of a rough time after the cooler than expected CPI and PPI of last week and the notion that the Fed did not raise rates on June 14th. As a matter of fact, if you look at June 14th, 13, 14 as a start date for several charts, you'll find some very interesting effects. If you use Fed Fund futures for July and look at the chart since the 13th, well, prices went up on the cooler than expected inflation data and on the Fed holding pat. But since then, it's been absolutely sideways at 70 to 72% of a quarter point increase for the July 26 meeting. So that's something to pay very close attention to. For tomorrow, boy, do we have some important data points, initial and continuing claims, and I will continue to stress that continuing claims may be the harbinger of the news the market wants to hear, and that is the labor market cooling down a bit. And what would that entail? It would entail continuing claims getting back over 1.8 million and climbing. We've already had a couple of initial claims that were a bit hotter than expected last month alone, 262,000. So we want to pay very close attention there. And leading economic indicators have been on a historic streak of consecutive negative months, and we want to pay very close attention to that trend. Reporting from the CME HQ, I'm Rick Santelli, CNBC Business News, Chicago.
Let's talk more about strategy. Let's get back to Michael Lighthead of New Capital. Michael, you heard what Rick Santelli was talking about. The jobs data is going to be front and center. You're watching that closely. And how will it affect the fixed income market?
Sure. So I think in terms of the jobs, I think the labour market reports, obviously, each month, the initial jobless claims that we're seeing, I think we've seen a little bit of volatility and some anomalies in there over the past couple of months. I think in general, employment and the labour market reports are going to be lagging indicators. Historically, it's not been the best indicator of where the economy is going, but clearly it's very important for the direction of policy. So for bond markets, I think they're going to continue to front-run those labour market numbers and really be watching for any signs of weakness. And the thing that we're particularly looking at is things like average hourly earnings and the trend in work hours, because I think that's going to be a better leading indicator on how companies are thinking about managing their employment. So I think bond markets will be looking to those types of more forward-looking indicators to sort of assess at what point we might see much more of a tipping point in the labour market.
Are you betting on a bigger inversion of the yield curve?
So what we think is that in terms of where bond yields go, we think that the sort of belly end of the curve is likely to be the area where we see the most sort of change and delta in terms of yields if we start to see that economic data sort of weaken off. So for us, I think short term, I think that very, very front part of the curve with it's very, very policy go higher. But I think that will, in the very short term, maybe pull those sort of belly yields a bit higher. But I think ultimately it's giving you the bigger optionality. So we see much more asymmetric risk. Prefer to move out the curve a little bit and think about how the curve will react in the event that we see a pronounced slowdown. So I think the best optionality in the curve right now is probably in the sort of 5 to 7 year part, where if rates had to come down much more substantially, something that's not really priced into the market in our view, then that would be the area where we'd see the biggest move in terms of rates. Whereas, say, the very long end of the curve, what we're seeing is we think inflation expectations are going to be slightly more sticky than they have been, in relative to the last decade, and therefore we maybe see a much steeper yield curve than we've seen, in sort of the past decade. So the sweet spot for us is certainly in that mid-range of the yield curve right now.
All right, so you're saying, Michael, not long duration, but that sweet spot right in the belly of the curve.
Yeah, I think mid-duration kind of is potentially the sweet spot. If we were to see rates come back down to sort of more like 1 or 1.5%, then you'd expect inflation expectations and growth expectations to keep the long end relatively elevated, but the front end is going to be much more positive, sensitive to policy. And I think people often think about just purely yield when it comes to fixed income, but when you're thinking about capital gains and total returns, then I think that mid part of the curve is probably where you're getting the best risk-adjusted returns right now.
All right, so what about the short end? Let's say the two, we're at 472-ish or thereabouts, and likely we're going to see it higher before things start to sort of steady out. It looks attractive, but are you concerned about reinvestment risk?
I think that's exactly the point. I think if you're in the very short end of the curve and you're locking in yields that seem higher today, I think if we were to see a more recessionary environment and yields drop, then extending out the curve a little bit, that's why sort of 5 years makes a lot more sense to us. you've kind of got that positive optionality, and you're avoiding that reinvestment risk. So to give up 20, 30, 40 basis points of carry for the potential option value of a price increase in bonds should yields drop, that seems quite attractive. And I think the downside risks, given the way yield curves are moving in terms of this in deeper inversions, if you like, when we see hawkish central banks, that means the downside risks we think are more moderate on that sort of element of the curve in sort of 5 to 7 year part.
Okay, got it. Michael, quick last one before we let you go. A lot of people have been talking about private credit, right? And I know you see risks in the private market default cycle. The flip side, though, is does that also potentially spell opportunity? I mean, it could be a great year for distressed debt.
Yeah, look, I think in terms of looking at the cycle and when the best opportunities typically come in for maybe on the more distressed side, we're not quite there yet. I think typically what we see, high yield default rates and indeed sort of default rates in general kind of lag the cycle a little bit, and so I would expect to see that come through as we see the Fed cut rates in a recessionary environment. So I think we certainly expect to see a pickup in terms of the level of distress. You see things like bank lending standards, particularly things like the Fed's Senior Loan Officer Survey, historically a very good indicator of default rates increasing, and I think that's going to start to pick up in the next 12 months. So it may not be the right time right now, but certainly there's an upcoming opportunity maybe in 12 months or so.
All right, wait till you see the whites of their eyeballs. Understood. Michael, listen, great to talk to you. Appreciate the time. Keep safe. We'll do it again very soon. Michael Lighthead, New Capital, joining us live. All right, spring back to this side of the world now and show you how markets are starting up Thursday trade. And we begin, as we usually do, down south in New Zealand. Wellington is down about 0.1%, so looking a little soggy. Their dollar to Kiwi, 62.03. Sydney opening up in less than 2 hours' time. SPY futures handicapping what looks to be a softer start. Australian dollar, AUD 67.98. Tokyo online, same time as Sydney. CME Nikkei futures are calling for a flat start at best, looks like. Dollar yen still tucked just under that 142 level, 141.77. We'll take a quick break. We'll be right back.
Or download the app.
Welcome back. Back on the box on a Thursday. There's a race going on to try and rescue 5 people trapped inside a missing mini submarine in the Atlantic Ocean. The minivan-sized vessel disappeared during a mission to tour the Titanic wreckage. This was a tourist submarine, and an international effort is underway to bring the crew home safely. NBC's Alice Barr has the latest from Washington.
A cavalry of new, highly equipped ships and underwater vessels joining the desperate search for the missing Titan tourist submersible.
This is a search and rescue mission, 100%.
After Canadian aircraft using sonar buoys detected underwater noises yesterday and this morning in a search area twice the size of Connecticut, while the U.S. Coast Guard isn't sure what the noises are.
What I can tell you is we're searching in the area where the noises were detected, and we'll continue to do so.
Top experts moving quickly to analyze the data.
The noises have been described as banging noises. But again, they have to put the whole picture together in context, and they have to eliminate potential man-made sources other than the Titan.
The race against time more urgent by the hour, with breathable air running out for the 5 people on board since Sunday, when the minivan-sized vessel vanished during a mission to explore the wreckage of the Titanic. Even once found, obstacles remain to reach the Titan and bring it to the surface from depths only those who've been there can describe.
The journey is amazing. You're basically going to another planet at the bottom of the ocean like this, 4,000 meter down.
Signing on for that otherworldly experience requires a $250,000 price tag and a massive waiver that former passengers say clearly warns the trip can result in death. The co-owner of the Titan's mothership saying that before they lost contact,
all protocols were followed for the mission.
as he and all those watching and waiting hold out hope rescuers can find the men in time. In Washington, Alice Barr, NBC News.
Well, in another development, the EU slapping another package of sanctions against Moscow. This includes forbidding transit of certain goods and technology via Russia on concerns they may be used to aid its military. The package also adds more reasons and entities to those already banned from the EU. And with the EU assets frozen, speaking from the Ukraine Recovery Conference in London, EC President Ursula von der Leyen stressed the role that the bloc plays in Ukraine's reconstruction efforts. Here's what she had to say.
I believe the European Union has a special responsibility. And the reason is simple. We heard the president. Ukrainians tell us that when they imagine their future, they see Europe's flag flying over their cities. And I have no doubt that Ukraine will be part of our union.
All right, coming up next, we're counting down to the Bank of England's decision later today. Will it deliver a bigger than expected rate hike as consumer inflation defies expectations and stays stubbornly high? We'll talk when we come right back after this. Welcome back. Take a look behind me. Not a great lead we're working with out here in Asia. Wall Street closed down all three major gauges. The Dow gave up 1/3 of 1%. S&P 0.5%. NASDAQ down more than 1% fully there. So we're likely to feel a bit of a downdraft out here into Asia. Take a look at yields. Here's how they're shaping up. Early Asia on a Thursday. The benchmark 10 at 372.66 to 2. Most sensitive what the Fed does or does not do for 71.95. Call it for all practical purposes 472. And this is the picture in markets. Equities as well as bonds posted day one, the first leg of what used to be known as Humphrey Hawkins' testimony up on the Hill. The Fed chair saying 2 more hikes before the end of the year's out. Well, that's not out of the question here. Dollar index, how did that respond? Take a look. The heavily euro-denominated basket at 102.081. So that's actually took a bit of a knock there. Dollar yen still tucked just under 142 at 141.75. And round off with oil and gold quickly. The black stuff, front-month NYMEX at 72.48, slightly softer. Brent, the international benchmark, popping though 1.5%, 77.03, with gold 19.33 and change a troy ounce. Chrissy?
Marty, well, the waning optimism on Wall Street also creating speed bump for EV makers such as Tesla and Rivian. CNBC's Steve Kovac is here with the details. Steve?
Hey there, Christine. Yeah, the shares of those two EV makers seeing red today. Let's start with Tesla, which saw shares fall more than 5% after a downgrade from analysts at Barclays. Barclays downgrading the stock from overweight to equal weight and suggesting investors take some profit now after the huge rally this year. Tesla is up a whopping 80% from last month's lows. Now compare that to the S&P 500, which is up about 8% over the same time period. Meanwhile, shares of Rivian also lower today, down nearly 7%. That's a day after the shares popped on the announcement the company would adopt Tesla's charging standard in future vehicles later this decade. And let's go back to Tesla for a second, particularly CEO Elon Musk, who had a meeting yesterday with India Prime Minister Narendra Modi in New York City. Tesla, like many other companies, are looking to India as a new engine of sales growth and manufacturing. Here's what Musk said about his meeting with Modi.
I'm confident that Tesla will be in India and will do so as soon as humanly possible. I'd like to thank the Prime Minister for his support, and hopefully we'll be able to announce something in the not-too-distant future.
Now Modi heading to Washington, D.C. next for meetings with business leaders such as Apple CEO Tim Cook and Microsoft CEO Satya Nadella. That's ahead of a state dinner at the White House with President Biden. Martin, I'll send things back over to you.
Steve Kovacs, excellent as always. Thank you very much. So Mr. Modi goes to D.C. We're going to be talking a lot more about business ties between the U.S. and India later this hour. Raymond Vickery from the Center for Strategic and International Studies, CSIS, joins us. He's got 45 years of experience in India, or with India, having first lived there as a Fulbright scholar. Don't miss that conversation. That's a little later this hour. For now, though, let's go over to the UK. Data out overnight showed CPI inflation there. Sticker prices rising 8.7% on year May, matching April's level and defying expectations of a slowdown. Here's what British Finance Minister Jeremy Hunt had to say on the back of the numbers coming out.
Today's figures strengthen the case for the government to stick to its guns. No matter what the pressure from left, right or centre, we won't be pushed off course. Because if we're going to help families, if we're going to relieve the pressure on people with mortgages, on businesses, we need to squeeze every last drop of high inflation out of the economy. And if you look at what's happening in other countries, you can see that rises in interest rates do bring down inflation over time. That will happen here, but we need to be patient, we need to stick to the course, and then we'll get to the other side.
Well, analysts expect the Bank of England, the BOE, to deliver another hike of 25 basis points to 4.75% when it meets later today as inflation stays stubbornly sticky. This despite the mortgage pain faced by British home buyers. Rising rates have pushed a 2-year yield mortgage rate to about 6%. Sterling looking choppy right now following the release of the CPI data, but the currency has been doing well against the greenback recently due to the rate differentials between the UK and the US. The pound still hovering at a 14-month high versus the dollar. Let's talk more about central bank, BOE, Fed as well. Tim Urbanowitz is head of research and investment strategy at Innovator ETFs. Tim, good to have you with us. You heard what Hans said, sticking to their guns. It's a double-edged sword, isn't it? I mean, you want to take out inflation, rising costs for consumers, but on the other hand, if rates do go higher, you actually increase mortgage repayments of millions of home buyers or homeowners.
You're exactly right, Christine, and seeing the data that we just got is not good news. To see the headline figures stay flat, to see core actually increasing, not good news for probably the most vulnerable developed market economy out there. And really, whether you see 25 basis points or 50 basis points, what this really tells us is that you're going to see interest rates that are higher for longer. And it really puts a lot of uncertainty around what that terminal rate looks like and how long the bank is going to need to leave rates at that higher level. So a lot more question marks with this most recent print.
So are they going to go for a bigger 50 basis point hike today, or are we going to see a slow and steady grind of 25 down the road?
I think they should do. You should see 50. Ultimately, we think they'll probably end up just doing 25, given where inflation expectations are. But again, the more important discussion here is how long do interest rates need to stay at these elevated levels? And a lot of the conversations that we're having with investors right now are centered around what does the new investment playbook look like in an environment where you have interest rates that are structurally higher for longer. This is not the decade that we were just in this 30-year bull market in bonds. This is a different regime, requires a new playbook. So that's really where a lot of the focus is right now with investors.
Yeah, Tim, I know that you think that's probably the right way to take a look at what's going on with the U.S. rates as well, right? It's not about whether the dot plots are right or wrong, whether we have one more plus 25 or two more plus 25 hikes coming before the end of the year's out. It's more wherever levels rates do end up, wherever there is, how long it's going to stay there before the Fed finally has to pivot and start a fresh rate cut cycle, yes?
That's right, Martin. And I think you listened to Chair Powell this week, put a couple more rate hikes potentially back in play. Really what we think he was trying to do there was, kind of keep financial conditions in check a little bit and give himself a little bit more flexibility moving forward here. We all know that monetary policy operates on delay. If you look at some of our research, we evaluated the last 9 hike cycles that we have seen in the U.S. just to highlight what that delay looks like. You look at unemployment. Unemployment on average through those cycles did not peak for an average of 1.8 years after that last hike. You look at consumer spending, which the consumer has really been the backbone of the economy here in the U.S. Up to this point, consumer spending doesn't bottom until about a year after the Fed is done and finished after that last hike. So really, he needs to buy himself some time to see what the damage that has already been dealt, what that damage looks like. But regardless, if we get one hike, we get 2 hikes, the real question is how long do we need to keep rates at that restrictive level?
Yeah, okay, fair enough, Tim. But, I mean, look, just for the sake of conversation, so, I mean, there's lag effect, there's the actual level where terminal is, and also the delta, how fast it takes to get there. What I'm trying to figure out is, if you take a look at the headline number, CPI, we've gone from, what was it? Where did we peak? About 9? We're more than half that. We're at 4 from the last print, right? Which sounds good, but the problem is that the Fed prefers the PCE, which is at 4.7 when it should be at 2. So my question to you is, for what it's worth, and just for the sake of conversation, okay, just humor me here, 2 more hikes, is that going to be enough to take PCE from 4.7 down to 2? I don't think it is. What about you?
I sure hope it is, and again, gotta see what the damage looks like here. We're still more than double where that 2% target is. The Fed's been very clear that they're not moving off of that target, and really, we need to start to see more progress in those non-housing services sector. We haven't really seen a lot. We've seen a lot of progress within goods, but again, Martin, I think from an investment perspective, we need to think about what does that new playbook look like. And higher interest rates not only have an impact on bonds, but they also have an impact on equities. Are you going to get a boost from valuation with higher interest rates? Probably not. What is it going to do to earnings growth? Probably slow. So a lot of the strategies that we're talking with investors about right now are strategies like accelerated ETFs, something like XBJA that's going to give you 2x the upside exposure on the S&P 500 ETF up to a cap with a little bit of a downside buffer in place. So these are new strategies that we have to think about incorporating. Again, we're not in the previous regime. We're in a new regime, and that regime requires new solutions.
So talking about strategies here and the conversations you're having with advisors, talk to us about PGAN. I guess that's how you would prefer to sell it or market it. What does that do for investors?
Yep, so PGAN is in the category of a buffer ETF. And really what buffer ETFs do is they're going to give upside exposure to a reference asset like the S&P 500 ETF up to a cap with a known level or a known buffer against losses over an outcome period. So for PGAN, you have a 12-month outcome period. You have a cap of right around 15% on the upside, and then a 15% downside buffer. So this is a strategy toward the beginning of the year. We were talking to investors about using it as a way to remain invested in the equity market, not just selling out and going to bonds. And if you look at it, the performance of the strategy this year, through the end of last month, up over 7% when the S&P 500's up, 9 to 10%. That's pretty good upside participation. And again, a way to remain risk aware, but not going risk off and just cashing in and going into to bonds or cash.
All right. Listen, Tim, fantastic talking to you. Appreciate the time. Great value. Thank you for joining us. Keep safe. We'll do it again very soon. Tim Urbanowitz there from Innovator ETFs joining us live from Chicago. All right, coming up next this Thursday, back with more events that could affect the market later today when we return after these quick words. Welcome back. It's Thursday, June 22nd. It's also the 5th day on the 5th lunar month on the Chinese calendar. China, Hong Kong, and Taiwan markets are shut today as a result, celebrating the Dragon Boat Festival. Chinese travelers are taking the opportunity to go on vacations during this long weekend break. Local immigration authorities expect daily average travelers to hit nearly 1.3 million, doubling from the same period a year ago. Chinese community in around the world, including Southeast Asia, also celebrates the festival by eating rice dumplings or zongzi, though it's not a public holiday here. Why not? I simply don't know. We're losing out, Marty. Losing out here, big time. Lobby for it.
Yeah.
All right.
Looks yummy.
Okay, on the policy front, aside from the Bank of England, the BOE, We're also going to hear from Indonesia, BI Bank Indonesia, and also the Philippine Central Bank later today. That is BSP, Bangko Sentral ng Pilipinas. Love saying that name. Analysts told by Reuters expect both banks to hold rates steady as inflation has eased in both countries and pause for the rest of this year. In other words, sit on their hands and do nothing. Meantime, here are some other events we've got on our radar for this Thursday trading day. Take a look.
On the economic front, we'll get the weekly initial jobless claims as well as May's existing home sales data. The Fed will also release its balance sheet data. Accenture, Commercial Metals, FactSet, and Olive Garden parent company Darden Restaurants all set to report their earnings results before the opening bell. NVIDIA will hold its annual shareholder meeting. Plus, a 5-day hearing for the FTC's injunction to block Microsoft's acquisition of Activision Blizzard will begin. In Washington, U.S. President Biden will host Indian Prime Minister Modi for an official state visit. And Federal Reserve Chair Jay Powell will continue his 2-day testimony before the Senate Banking Committee.
Out.
Welcome back. It's a Thursday here on Squawk Asia. India's Prime Minister Narendra Modi is attending a private dinner with U.S. President Joe Biden later tonight. And we could get live pictures of Prime Minister Modi arriving in D.C. Very shortly, and we'll get those to you and bring them to you. The Indian leader is also going to address the U.S. Congress Thursday stateside. Modi and Biden will then hold a joint press conference where Modi is expected to take questions from the media. Now that is extremely unusual. And it's sort of a coup for the Washington press corps because like his Chinese counterpart Xi Jinping, Modi has never addressed any press conference since assuming power about a decade ago. Now, Modi will also dine with a number of big tech CEOs, including Apple's Tim Cook, Microsoft's Satya Nadella, and Google's boss Sundar Pichai. The corporate executives could use the opportunity to express their frustration over regulatory hurdles and also India's laws that could increase government oversight on business. Right, let's keep talking and bring in Raymond Vickery, Senior Associate Chair in U.S.-India Policy Studies at the Center for Strategic and International Studies, CSIS, also former U.S. Assistant Secretary of Commerce for Trade Development. He joins us now live. Raymond, good to talk to you. Appreciate your time. Thanks for staying back to do this with us. I know it's getting late where you are. How significant in your mind, in your view, is this Modi trip to the U.S.?
Well, I think
I think it's very significant. The economic relationship has been a driver in the U.S.-India relationship ever since the Indians did away with the license Raj back in the 1990s. But there's still a long, long way to go. The story, of course, with India and its economy is one of growth. It's one of the fastest growing economies in the world right now, even though it starts from a low base. And it is the economic component of the
Right, Ray, if I'm not mistaken, I think we're looking at live pictures right now. I take that back. These are not live pictures, but we are expecting live pictures of Modi's arrival, and we'll bring those to you when we have them. But Ray, let's keep talking meantime. Okay, we're having technical problems with Ray as well, but one thing I think to any expert we talk to, Christine, with regards to this Modi visit to the U.S. is, I mean, it's interesting because it's only, I think, the third time that Biden has done a state visit. This is the full works, roll out the red carpet for any foreign leader, right? So it's kind of a privilege there for Modi, and especially for a country which has not really taken a side or stand in terms of Ukraine-Russia, that war. So it seems to suggest that India and Modi are kind of indispensable to the U.S., like it or not.
In a way. I'm amazed because with Modi now visiting the U.S., it's a landmark visit, surely. And also he's dining, he's really there to bring in investors right into the country. He's having a meal, or he's having a meeting with Tesla, or he had a meeting with Tesla, simply to get Tesla to start producing EVs in India. So that's going to be key, because to me, China already has Tesla in China, right? So Modi feels probably the pressure to do the same, to bring something back substantial into the country. Because it's all about money at the end of the day, isn't it?
Indeed, yeah. And Elon Musk, he said it himself. We've heard that soundbite where, look, nothing to say now, but watch out. Could be announcing something very shortly about an investment of some sort in India by Tesla. All right. So as we go along, we have a couple of minutes left, so I guess while we try and fix the phone lines to bring Ray back, we can keep talking about India. What's interesting is what Modi wants to get out of this trip to the U.S. I think one of the things to keep an eye on is military assistance and support. I have a sense that India under Modi is trying to wean itself away from overdependence on Russia for military supplies. That's one thing. And two, given the size and the power of India's economy, it is still not part of Iran does not have a seat on the UN Security Council. Maybe a long way off, but I think that's something that Modi is hoping that closer ties with the U.S. will help him achieve at some stage. But anyway. All right, we are going to try and get back to Ray Vickery. I think we fixed our phone lines. Senior Associate Chair in U.S.-India Policy Studies at CSIS. Also a former U.S. Assistant Secretary of Commerce for Trade Development. Ray, I'm not sure whether you heard Christine and I talking about Prime Minister Modi's visit, but what strikes me as unusual is, I mean, look, this is the third time that we've seen the president roll out the red carpet, and this is full state visit, full honors for a foreign leader, so this is pretty significant. But this is for a leader and for a country which still has not really taken a side or definitive side in terms of Russia-Ukraine, and which not so long ago under a different administration was being heckled for its human rights record, but yet he still gets this kind of treatment. What does that say to you?
Well, what it says to me is that there's been continued progression in the U.S.-India relationship, that it's no longer transactional, and that the Biden administration has placed a huge bet on the U.S.-India strategic and economic relationship. And that is not contingent upon India supporting the United States down the line. It's not an ally relationship, but it is one of equal partners and equal strategic interests. China, of course, being the biggest one. China claiming an entire state, Arunachal Pradesh, of India, and also being a very great concern to the United States as it tries to expand into the South China Sea and to threaten Taiwan. So China is a big part of it, but also there is a huge relationship on the economic side. You may have seen that one of the progress points has been in regard to trying to move some of the chip manufacturing and chip design into India, so that India is a reliable partner in the chain which produces these very fundamental kinds of chips. So it's an alliance at this point which has progressed beyond the transactional and is into the relationship between these two great democracies. Now, that doesn't mean that international values such as the rule of law that have been trespassed by Putin and the Russians in regard to Ukraine are irrelevant. There will be further talks about that, but the Biden administration understands the historic background that has brought India to what we view as an overdependence on Russia. And so the attempt will be to move forward on joint activities, GE engine manufacturing, the provision of drones, and all along the security front in regard to a security economic relationship. It's very important, and it is a sea change, as you rightly have pointed out, in the U.S.-India relationship.
Raymond, this is Christine. Very quickly, we have a little bit of time left. What do you make of that GE deal that India is now in talks with? I mean, getting GE manufactured fighter jet engines into India, a deal which Delhi wants to buy General Atomics. It's all about technology, isn't it? I mean, it's all about defense systems as well. What do you make of this deal in terms of this realm of sensitive technology and how sensitive it is to both countries?
It's all about technology. And it shows that the United States is putting its trust in India to be a part of the supply chain, not just in civilian products, but in defense projects across the board.
Okay, Raymond, we'll have to leave it there. Thank you so much for your time. Great talking to you. Raymond Vickery from CSIS. We will count down to all the market open in Tokyo, Seoul, and Sydney. Squawk Box will be back in 2. Stay with us.